Understanding related party transactions, significance, regulations, and risks. Related party transactions are pivotal in the financial realm, sparking discussions on ethics, legalities, and corporate governance. As organizations navigate business landscapes, these transactions can either foster beneficial collaborations or lead to conflicts of interest that jeopardize stakeholder trust. This article delves deeply into what related party transactions entail, their types, regulatory oversight, implications, and the risks involved. Definition of related party transaction. A related party transaction refers to any arrangement or deal between two parties that already share a pre-existing business relationship or common interest. These transactions are commonplace in business settings, as companies often prefer dealing with familiar associates, be it individuals or entities. Why are related party transactions common? The inclination towards related party transactions stems from the benefits of established relationships. Companies believe they can negotiate better terms based on existing trust and understanding. Furthermore, familiarity can speed up decision-making processes, thereby enhancing operational efficiency. However, these benefits do not overshadow the potential risks they pose. Types of related party transactions. Related party transactions can manifest in various forms. Some common types include sales. A company might sell products or services to a related entity at a negotiated rate. Leases. A business may lease property from an owner who is a shareholder or executive. Service agreements. These may involve hiring consultants or service providers who have familial or business ties to the company. Loan agreements. An organization may lend money to a related party, often under more favorable terms than what banks would offer. These examples illustrate how intertwined financial decisions can be influenced by past relationships rather than purely business metrics. Regulatory oversight. In the United States, regulatory bodies such as the Securities and Exchange Commission, SEC, rigorously oversee related party transactions to prevent conflicts of interest and protect shareholder interests. Disclosure requirements. Publicly traded companies are mandated to disclose all related party transactions in their financial disclosures, specifically in quarterly, 10-Q, and annual, 10-K, reports. This requirement aims to maintain transparency, ensuring that all stakeholders are aware of potential biases that could influence business decisions. Standards established by FASB. The Financial Accounting Standards Board, FASB, also plays a crucial role in setting rules that govern how related party transactions should be accounted for, promoting transparency and consistency in reporting. FASB's guidelines typically involve monitoring payment terms and competitiveness, establishing authorized expenses, ensuring that transactions are documented clearly and adequately. Impact of the Enron scandal. The necessity for stringent regulations surrounding related party transactions was underscored by the infamous Enron scandal in 2001. Enron utilized related party transactions through special-purpose entities to mask billions in debt. This deception not only led to the company's catastrophic collapse but also prompted the introduction of the Sarbanes-Oxley Act of 2002, which enhanced reporting requirements and instituted specific rules aimed at curbing conflicts of interest. Audit challenges. Despite artfully designed regulations, related party transactions can present significant challenges during audits. Owners and managers hold the responsibility to disclose all related entities and their interests, but non-disclosure can lead to undetected fraudulent activities. Transactions may be recorded among general business activities, complicating the audit process and making it difficult for auditors to classify them appropriately. International perspectives. On the international front, the International Financial Reporting Standards, IFRS, also governs related party transactions. IAS 24 outlines requirements for reporting on relationships between parties and transactions to ensure that financial statements reflect any possible influences on financial positions and profit or loss resulting from such relationships. IRS scrutiny. The Internal Revenue Service, IRS, takes a keen interest in related party transactions under Internal Revenue Code 267, particularly focusing on whether these transactions generate conflicts of interest. If any irregularities are found, the IRS may disallow tax benefits associated with those transactions, especially in cases involving property sales and deductible payments. Conclusion: understanding related party transactions is integral for anyone engaged in the business sphere. While they can provide advantages such as familiar negotiation benefits and quicker deal closures, the potential for conflicts of interest necessitates strict regulatory oversight. Compliance with SEC, FASB, and IRS guidelines is crucial for maintaining transparency and protecting stakeholder interests. Ultimately, transparency and adherence to regulatory standards can foster a business environment that encourages trust and minimizes the risk of unethical practices in related party dealings.